Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. So the Federal Reserve just announced this week that they were hiking rates by 25 basis points, and Jerome Powell hints at a potential pause in the hiking cycle, which signals a very important shift in the macro environment compared to what we've witnessed over the past year, where the Federal Reserve has been on a mission to raise rates very aggressively. It seems like they're shifting their tone right now, and yet the markets are moving down following that announcement. The Federal Reserve is losing control. The market is seeing through that, and I'm going to show you exactly why in this video. We're going to go back and look at a very similar moment in stock market history and see how things played out from that moment. Don't forget to smash the like button if you enjoyed this video, and of course subscribe to the channel if you haven't already. Now without further ado, let's get right into it. So let's take it back to the basics. Ever since the financial crisis, we've had inflation hover around 2%, which has given the Federal Reserve a lot of room to ease monetary policy when you saw a downturn. So one of the things that we've seen over the past decade is the expansion of the Federal Reserve's balance sheet. Every time you had a downturn in the US economy, you saw programs like QE that injected liquidity into the financial system, propped up the stock market, propped up the economy. And so systematically, we've seen that create bottoms in the market. And you look at, for example, 2019, right here, December of 2018, actually, where the Federal Reserve announced that it would be pausing monetary policy. You saw the stock market go on an incredible run following that bottom. So why are the markets not melting up today? Why are they not breaking out here as the Federal Reserve is potentially signaling a pause here? Well, if we go back in recent history, of course, we can see multiple examples where we saw the Federal Reserve ease monetary policy, and yet the markets were going down. So as a general rule, a Federal Reserve that is easing doesn't necessarily mean that the stock market is going to go up. Because if the economy is tanking as they're easing, you're most likely going to see the stock market go down. But today I want to focus on a particular bear market, the 1970 bear market, that is unbelievably similar to today's price structure. And this is going to give us a roadmap for how things can play out this time around in the coming months. We can divide this bear market into three different phases that occurred. The first one being right here, that started at the all-time high in December of 1968 and ended right here in August of 1969. If we look at inflation throughout this period, you can see core inflation had been trending higher leading up to that phase at around 4.5 to 5.5% here. So very strong inflationary pressures back here. And if we add the federal funds rate on top of this chart, you can see that the Fed actually only began to tighten in October of 1968. So the Fed was very late to the game in 1968, despite the fact that inflationary pressures were ramping up. Specifically, look at this phase right here. You can see inflationary pressures ramping up and the Federal Reserve hiking rates very aggressively. Meanwhile, you look at S&P 500 valuations in 1968 and they were very elevated. In December 1968, valuations were almost at 20. And so in this first phase of the bear market, you had the Fed tighten, which brought down market valuations throughout this period. And to be clear, this was a moment where the economy was very strong, the labor market was very strong, so the market was absolutely not pricing in a recession throughout this period. If we compare that to the price action that we saw in 2022, and we assume that this was the first phase of the current bear market that we're experiencing, you can see inflationary pressures were ramping up as the market was making new all-time highs. The Federal Reserve was late to the game and they began tightening in early 2022, which caused the markets to go down because S&P 500 valuations were incredibly elevated here, with PE ratios in early 2022, I believe, were hovering around 24. So that caused a market correction as you had that tightening cycle. But remember, this was an environment where you had a very strong economy. The labor market was very hot at that moment. The economy was showing strength. So the market here was not at all pricing in a recession. So we've seen the similarity between the first phase of this historical bear market to what we've seen so far in the current bear market. Now let's take a look at the second phase right here. Now, during this moment, you actually saw the market rally quite significantly here. And you look at the bond market yield curve back then, and it was inverted here. So the bond market in 1969, during this bear market rally, was signaling that a recession was not too far off. Now, you can see in terms of the price action, we had a price channel here that we've talked about before on this channel, and price made its way up from the bottom of the channel to the top of the channel, despite the fact that the yield curve was inverted and signaling the fact that a recession was coming in our way. And you can see in terms of the retracement that we saw throughout this period, we take a look at the Fibonacci retracement levels. This bear market rally retraced 50% of the move down that you saw from the all-time high. Now, if we put the federal funds rate on top of this chart, you can see the rally here really started as the Federal Reserve was pausing monetary policy. It stopped its hiking cycle here. The Federal Reserve paused its hiking cycle and stocks rallied up to that resistance level and retracing about 50% of the move down that we saw from the all-time high. You can see here this bear market rally reaching that 50% retracement level. So if we fast forward to today and we take a look at the second phase of the bear market, we look at first of all the yield curve. Of course, it's been inverted throughout this entire phase. So the bond market is telling us that a recession is just ahead of us. And we think about why the market has been moving higher. It's been the front running of the fact that the Federal Reserve is going to ease monetary policy. Stocks have been running up from the bottom of the channel all the way to the top of the channel. And now that any pivot in monetary policy that's coming later this year has already been priced into the markets, stocks really only have downside here as we enter the third phase of the bear market, where you start to see the recession get priced in. And of course, you're going to quickly see what that looks like on this chart here. The market begins to aggressively price in the recession. The market bottoms very quickly into the recession as you start to see the unemployment rate rise significantly, during which time you also see the Federal Reserve ease monetary policy very aggressively here. So you go from an environment in phase one where stocks are moving down as the Federal Reserve is tightening monetary policy with a strong US economy, to an environment where the Federal Reserve is easing monetary policy and stocks are going down because you're heading into a recession. So this is what seems to be playing out in the market right now. Now, of course, no two bear markets are the same. You can have differences, just like phase one and phase two don't look exactly the same as what we have today. Phase three is probably not going to look the same either. But hopefully this gives you a good idea of why the markets are actually moving down, despite the fact that the Fed is beginning to sound a lot more dovish. And that's because that news is probably already priced into the market, while the recession that is being signaled by the bond market has yet to be priced in by the stock market. Now, I strongly believe that it's when the market goes down that you can make the largest profits in the market. If you're properly positioned for drawdowns in the market and you're actually able to grow your portfolio throughout these periods, hedge against risk, and most importantly, hedge against the right type of risk, you're going to be extremely well prepared for when you do see stocks at an attractive and much cheaper buying opportunity. And that's exactly what we're looking to do at gameoftrades.net. Our investment strategy revolves around making as much possible gain during bull runs and hedging against any type of risk during market turbulence. We think we have our model portfolio ideally positioned for that. We're also very transparent about all the trades that we've made in the past. We share our complete track record, which is something that no other service out there does. So if you want to take advantage of our service, sign up to the free trial by clicking on the link down below. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash the like button and of course subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.